Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. It is Friday, October 12th. And we're talking about one of the biggest tech IPOs of 2018 and why investors are going to have to wait just a little bit longer for it. I'm your host, Dylan Lewis, and I'm joined on Skype by senior tech specialist Evan New. Evan, what's up?
Not too much.
We have done a lot of shows on the blank of China. We have another business that we are going to be talking about today that fits that bill, and that is Tencent Music.
Right. So you could call it Spotify of China, but you could also call it the Twitch of China. So both kind of, fit that fun little of China and that everyone loves to do.
You allude to that there. There's kind of a hybrid business model that we'll get into. Some of it is going to be very familiar to people that follow Spotify and the streaming music space. Some of it is going to be very familiar to people that follow the Twitch and gaming space here. But it is a fun one for us. This is a company that was supposed to be going public relatively soon. More on that later. Those plans have changed. But it is the largest online music platform in China. Over 800 million mobile active users across its 4 properties. And you mentioned it's the Spotify of China. Kind of, we have this conventional streaming content approach, and this is music, video, studio, live music recordings. And that all happens within some of these portfolio products they have, the QQ Music, Kugo Music, Kuwo Music platforms. And it looks a lot like Spotify, Evan.
Right, and I would also mention that at 800 million users, that also makes them not only the biggest service in China, but also the world. I mean, if you compare that, their online music, they have about 650 million users, of which 25 million are paid. So for reference, Spotify has 100 million free users, 85 million paid. Apple Music, of course, has no free tier, so they only have a paid version, which they have 40 million. So Tencent Music is enormous in terms of the user base.
And this is the part of the model that will feel familiar to most folks. It's paid subscriptions, digital music sales, and online advertising. They also have something that is quite a bit different than what we think of with the online music space, and that is their social entertainment services. And when I think of this, it's primarily the WeSing platform that they have.
Well, so this is things like karaoke and other live music performances. And, Tencent Music mentioned in their F1 registration statement that the Chinese market for live offline music performances has always been very small because it hasn't been very accessible compared to in the U.S. where, here we like to go out and see shows and go see bands. Pretty common. It's a pretty big industry here. But over there, the market is just so small. So that's created this kind of alternative market of, people want a demand for live streaming online performances instead.
And as for what this experience looked like, it's video sharing, it's karaoke parties, it's virtual karaoke rooms, and I think even some duets with celebrities, kind of unlike anything we have here in the United States, but very similar if you port over to the gaming side of things and think about Twitch and the idea of kind of this shared experience, even though it's a digital experience, kind of doing video game walkthroughs with people and watching people play. And the monetization for this type of business is very similar to Twitch. It's paid subscriptions, it's gifts, it's kind of online mini payments the way you would almost have with a video game.
Right. So on Twitch, people might be more familiar with how Twitch works, which is predominantly, video games and esports where you're live streaming yourself playing a game and you have these viewers that will contribute cash donations as well as, like you mentioned, these virtual gifts or paid subscriptions to their channels. So basically, instead of just video games over in Asia, they have all sorts of different types of ways to create this entertainment with these live streaming platforms. Like, for example, in Korea, we were talking about it. People in Korea like to watch people eat. Like, people live streaming themselves eat. In China, it's karaoke, and other live music performances.
And this is not a small portion of the pie for Tencent Music. In 2017, 71% of the company's top line came from the virtual gifts and premium membership segment, which is to say that 30% came from the streaming music operations that are familiar to us when we think Spotify, which is just a very different model than what I think a lot of people are expecting when they hear the Spotify of China.
Right. I mean, the business is really built on this, social entertainment as part of the business. As we've talked about before with Spotify, I mean, they have to pay these huge royalty costs. They're unprofitable, but Tencent Music is very profitable. They had about a 20% net margin in the first half of the year. And to put some more numbers to it, like the social entertainment user side, they have about 230 million users, of which 10 million pay. And if you look at the average revenue per user on each side of this business, on the music side, converted roughly from yuan, it's about $1.27 on the music side. Average revenue per user on the social entertainment side is $16.28. So that's almost 13 times greater than the music side. And we're talking about half as many users on the social entertainment side, contributing, as you mentioned, 70% of revenue. So it's just a huge business for them on that part.
Right. When we started doing our digging on this company, I was thinking, okay, here comes another high growth platform tech company. It's not going to be profitable. And the thing I was most immediately struck with was 1.6 billion in revenue and a profit. And so 240 million in profit in 2017. So far for the first half of 2018, the company's put up 1.3 billion in sales and already topped their 2017 net income figure. This business scales a lot better and a lot more immediately than what we see here in the US with Spotify.
Right. I mean, the cost structure is just totally different. If you look at Spotify's numbers, 70-80% of their revenue goes towards royalty costs. And for Tencent Music, I would imagine their music business is roughly the same, since they also have to have similar licensing agreements. But on the social entertainment side, which, as we've been talking about, is much bigger, their main costs are like revenue sharing agreements with your content creators and things like that. So you don't have as much royalty burden.
It's rare to get a bundle of high growth company, profitable, still a pretty big growth runway in front of it. It seems like that's what we have here, but I think it's kind of important to understand what's going on and where the growth levers really lie for this company. So when I look at their growth figures, about 650 million monthly active users on the online music services. You mentioned before just over 200 million monthly actives on social entertainment. The growth rates for them have been relatively low as of the most recent quarters. For the online music services, it's the low single digits. I believe social entertainment was somewhere around 14% year over year recently. We think about the 1.4 billion number for the Chinese markets, but I still think that a lot of this has been realized already. I think there's already some market saturation happening with their user base.
I do think that in the longer term, I think that they still do have plenty of upside because internet penetration in China is still around this 40% level. Like you mentioned, 1.4 billion total population in China, and I think the total internet users in the country are somewhere around 800 million. So you still have hundreds of millions of people that have yet to get online. How fast that happens, of course, is a little bit harder to predict. But I do think over the long term, they should have no shortage of users to keep getting onto this platform.
Yeah, and that's definitely more of a short-term outlook for me. It's the next couple of years, I think, for the most part, a lot of the growth that we see with them, particularly on the top line, is going to be driven by its existing user base. And right now, their pay rate among users is very low. 3.6% pay for online music services, 4.2% pay for social entertainment services. That's a huge opportunity for them, but I think it also speaks to kind of the customer expectation and the dynamic. Both of those rates have been growing over time, but they are low when you consider the overall base of users they have.
One quick note that I think is worth acknowledging is that the way that they report their paying users is they only count people that have subscriptions. So like if you have an a la carte purchase of some digital music, they actually don't count you as a paying user, even though you actually are paying, obviously. So it is something interesting there in how they report it. So just another thing for investors to keep an eye on.
And that is why you have to read the prospectus, Evan. Great point there. I think looking at these numbers, the challenge for them is going to be getting more users to pay for the service and getting users to pay more once they are paying for the service. And so that is their average revenue per paying user number. It has generally been up on the social entertainment side. Streaming music has been all over the place for them on an ARPU basis. I'm not really sure what's going on there. There's been no consistency on a year over year or sequential basis in terms of growth.
Right. I mean, there's generally speaking, a lot of Chinese consumers, they have this part of their mentality is they don't really like paying for things online. But I think that when you talk about the entertainment experience part of it, I think there is a greater propensity to actually open up their wallets and contribute to these performers that are actually providing entertainment to them. So I do think it is a pretty stark contrast, and you can see it played out in the ARPU numbers too.
So Evan, as the company name might suggest, Tencent Music has a pretty big strategic partner as it looks at the mobile space in China.
Right, so they're owned by parent company Tencent, which owns about 60%, I think 58% of outstanding shares. So they're obviously going to have majority control, pretty much determine the strategic direction of this company. You have company insiders owning another 8%, And then you also have Spotify owns about 9% of this company because Spotify and Tencent Music did an equity swap in December of 2017, where they exchanged stock for positions in each other, so they can also advise each other on strategic matters. They can learn from each other, give each other tips, and so between all that, that's about 75% of all shares that are going to be locked up by these entities, which means that whenever the stock actually goes public and starts trading, your float is going to be 25% or less.
Yeah, and this kind of gives them a lot of different strengths, right? It gives them some stability. It has a lot of people that are really bought into the success of the business. And I think in the case of Tencent, I mean, it gives them access to this massive platform. They have, I think, over 1 billion monthly active users on its apps. And, having access to that from a strategic perspective, access to the social graph there, and kind of understanding some of the user data on that side will be incredibly beneficial for them as they're trying to grow their user base.
Right, so they definitely will have all these different types of cross-selling, cross-advertising, cross-promotion, all sorts of things, because Tencent owns WeChat, which is just enormous and completely ubiquitous in China. It's everywhere. And being able to really tie into those services, I think, is a huge advantage.
And just within the space, we touched on it before, but it's worth kind of bolding and underlining. It is the largest platform in the market when you compare or when you combine all of its apps users. It's also the largest in the world, to your Spotify comparison earlier, not on the paying side, but in just its general presence. And the users are highly engaged. Every daily active user spends an average of 70 minutes per day on the platform. That's engagement that is pretty hard to match. So I think there are a lot of really good things going for this business right now.
I like it actually a lot more than Spotify, which I actually own stock in. But there's a lot of things that I do like about this business and the numbers that they're putting up already.
Now, of course, with all of those strengths, there were some concerns about market volatility recently. We've had some pretty big sell-offs, particularly in the tech space. And so this was an IPO that was slated to happen at some point in the next few weeks. And it seemed like the book building was in process pretty much. Recent news indicates that that's going to be delayed a bit.
Right. So the markets have been pretty choppy over the past couple of weeks, particularly with the massive sell-off that you mentioned this week that wiped out 3 or 4 months of gains in the major indices. And yeah, tech took it pretty hard, especially. But there's been some concerns about rising interest rates, et cetera. So now Tencent reportedly wants to wait a little bit longer to go public, at least until November, even though it already filed this F1 registration statement at the beginning of October. It was previously expected to do a roadshow as early as next week and then go public by the end of the month. But if you think about it, it makes sense because this was going to be one of the biggest IPOs of 2018, valuing the company at somewhere between $25 and $30 billion. And that's a pretty huge valuation, especially for a Chinese company going public in the U.S. And the size of that deal could be at risk, specifically as it relates to the IPO pricing, because IPOs are priced based in part on investor demand. And if all this recent volatility has dampened the market's appetite for risky stocks, and all IPOs are fundamentally very risky, then you can see how they'd be a little bit worried that if there's not enough demand, pricing could get hurt, and then that kind of ruins your positive headlines and big press and celebration of being this huge deal.
Yeah, it is not unprecedented for a big IPO to be delayed, and this is something we've seen in the past before. To your point earlier about this being a pretty appealing offering, I'm with you. I think that this is a very interesting stock to watch, and certainly a company that I am interested in. You look at that valuation range that they were targeting, 25 to 30 billion. That puts them at something in the neighborhood of 10 times sales, give or take. If they continue on the run rate that they've been on the first half of 2018, and they're already profitable, the path to long-term profitability, the path to them kind of being a successful, sustainable business is already there. It's not something that you have to bet on, and it seems like there's still a lot of growth built into this business.
Yeah, I'm definitely interested. I'm not sure what I'm going to do quite yet, but it actually makes me very curious about Twitch. Amazon bought Twitch several years ago for $1 billion, and before they really had a lot of these monetization strategies in place. So I'm very curious of how big the Twitch business has grown for Amazon, but Amazon doesn't really disclose anything about Twitch. And when you see the success of Tencent Music, which, as we've mentioned, is kind of this hybrid model between Twitch and Spotify, with the vast majority of the money coming from the live streaming side, it makes you wonder about how the Twitch business is going for Amazon too.
Yeah, we might actually have to do a show on Huya down the road, which is kind of considered the Twitch of China. That is a comp for Twitch and maybe a little bit of an insight into what's going on the books there. I guess that will be our next blank of China show, Evan.
There's no shortage of blanks of time.
We'll keep them coming. Evan, thanks for hopping on this show. Listeners, that does it for this episode of Industry Focus. If you have any questions or if you just want to reach out and say, hey, you can shoot us an email at industryfocus@fool.com, or you can tweet us at mfindustryfocus. As of this week, you can also find all of these podcast segments on YouTube. You can check them out at youtube.com/themotleyfool. If you're looking for more of our stuff, subscribe on iTunes or check out the Fool's family of shows over at fool.com/podcasts. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against stocks mentioned, so don't buy or sell anything based solely on what you hear. Thanks to Rick Engdahl for all his work behind the glass today. For Evan New, I'm Dylan Lewis. Thanks for listening, and Fool on.